Though he was on CNBC, Dan Ives, the king of Tesla analysts and the most bullish analyst of all time, said, "Pick your spot, it's been bad." He seems to be saying that the market is not as bullish as it was, but he is still more bullish than 99% of analysts. You have to give him credit for that because, if you're a Tesla investor, what he was discussing is the current status of Tesla, which is the equivalent of having 3 root canals without anesthesia at this point. However, he was essentially stating what must occur both now and in the future. Expecting the stock price to begin rising now that Tesla has lost 35% of its worth in 2024. This essentially says that the year is not going well for Tesla thus far. It is the lowest since June 2023. There has been slowing growth, price cuts, and delivery delays due to China demand concerns. There is a lot of negative emotion and bad press since 10% of employees are fired and executives are still alive. One thing about humans, though, is that we are far more sensitive to losses than to gains in the stock market. Therefore, the mathematical formula is +1 for each percentage point that your stock price increases and -2 for each percentage point that your stock price decreases. That's why it's not fun to be an investor. But if you have a long-term perspective, it's actually not a bad thing. I'll explain that in a moment. But let's focus on what Dan Ives said. This is probably the worst period that I've seen. I'd say about 6 years for Tesla, and patience is wearing thin. You see from an invest perspective, and obviously you know many throwing in the towel. So when we see a 35% drop in 1 year, not even in 1 year since the beginning of 2024 in 4 months, that's equivalent of a 70% gain in the same time. We are still optimists since the long-term story is still intact. But there's a chance that things might get darker if Musk doesn't act like an adult in the room and provide some guidance and direction in the form of a lot of questions. After all, this is white knuckle. As of right now, I can attest from personal experience that the China EV market is similar to the music video Thriller, and it has undoubtedly been a major obstacle for Tesla, which is actually a crucial aspect of the company's growth. What I believe investors need know is how they plan to turn things around and whether pricing will be maintained. Additionally, Model 2 is crucial since you need it to have a growth story throughout the ensuing 18, 24, and 36 months. It's a scary idea, but when Tesla talks about 2 growth waves, the second wave is Model 2 refresh Model 3 Model 1. And obviously some other models that they're going to introduce, but that's the issue right now in terms of Model 2. In my opinion, that is the most important thing for them to understand at this moment, and he should be on the conference call to discuss it. I mean, if they don't do Model 2 and went straight to autonomy, that would be like being at a cliff in the Grand Canyon and looking down below. You cannot go straight to autonomy. Clearly, some of you have already reported it. In my opinion, when I say that the clock is ticking on midnight, it is because we must navigate the Category 5 storm, just as he has a 2018, 2020, and other year. Don't just take my word for it, though. I believe that this is the real source of frustration, as we've gone from a magical corporate journey akin to a Cinderella story to something of a horror show. Particularly in the last 3 to 4 months, autonomy will be crucial. But given the regulations at play, we won't actually see drivers using new steering wheels in 2030. In terms of autonomy, that looks fantastic on a PowerPoint in science fiction. And we do believe in the autonomous vision, but in the short term, the focus is on growth. What will free cash flow look like? How can the growth trajectory be reversed? How can 3, 4, and 5 million units be reached? The only way to get there is to purchase a Model 2 car for less than $30,000. Since the Model I Cybertruck is still very limited and not intended for the mass market, there hasn't really been a need to refresh the product line. This is the problem here. The company has given only an approximate estimate for the future and hasn't provided accurate guidance, so it's unclear where gross margins will level out given the range of charges. What would be a reasonable delivery number? 1.95 is equal to 2 million. What does growth look like? Give the 2 to 3 targets they need to essentially reinforce the low-cost vehicle and the model. Then give a plan for the upcoming 6, 9, and 12 months. This may just be a trust me autonomy, We'll get back to you in 2030. For this reason, a lot of people are quitting because of their concerns, which are well documented, and the cost cuts, which were, in my opinion, somewhat devastating for a company that ought to be expanding. Then I replied that this was the lowest point in Tesla's stock price in years. In terms of stock price, he is correct. However, in terms of the company, I'm not so sure. He is stating that investors' patience is running out, which is a true statement, so I believe he is correct. Many investors, particularly in the retail sector, are not happy about that, and that's understandable given that when a team continues to lose, a lot of fans cease attending games. Many free riders on Tesla, or bandwagon fans, are, in other words, pulling out at this point. That being said, it's normal. What I find significant about this interview is that fact. When I asked him what he thought should happen in the upcoming earnings call, he basically said, "Look, it needs to be handled with lots of care. At the last couple of calls, people are not so confident about the way these calls are being handled. They have to go to Wall Street talk, not the Elon craziness that we've seen of the past two calls." I told him that, "Look, I'm still bullish on Tesla long term. The story of the Tesla growth is still fully intact." He also mentioned his concerns about how Tesla interacts with investors and the lack of transparency about the company's future strategy. However, I find it strange that he would question that it's difficult to distinguish Elon Musk's crazy between good and negative. I mean, Elon is Elon. You get the brilliant and the crazy inventive parts, but you also get this. He's a very genuine guy who won't suddenly become a Wall Street CEO. That's just the way it is. I mean, you have to deal with Elon. It's inevitable that you will experience both the good and the bad. People will lose faith in the company if Elon Musk adopts a phony persona and sticks to talking about Wall Street. That's not a good idea. But having said that, I do agree with a few things Dan Ives said, which is that we need more transparency from these calls regarding the strategy's future and more discussion about the current issues and headwinds and how the company essentially plans to handle them. Beyond the cliche that says, "Hey, in 2030, we're going to be absolutely massive." Dan and I both agree on this, but you know that I'd be interested in learning more about what transpires over the following few years. In the short term, we hear a lot about 2030 and the following 5 years, so 2 or 3 years more. Although it's not great, it's acceptable to provide an update about what will happen in the upcoming year. In my opinion, though, they should sort of address the China demand because it's been circulating on social media and mainstream media. People are hammering home the point that this is the end for Tesla, which is obviously not the case. Come on, but you have to address it. If you ignore it and you don't say a word about it, it just makes you look bad. And why not? I agree with that. Additionally, he mentions the need for the Model 2, which is that sub-$30,000 vehicle, to be released soon. Since that's the next S-curve for Tesla, essentially what he's saying is that we have a long way to go before FSD becomes fully mainstream, 5 to 7 years, and we need to fill that gap with a mass-market product. I believe Dan doesn't really trust a Cybertruck to do that. It's still too early to tell, but he's basically saying that the Cybertruck might or might not succeed. However, if you release the Model 2, or as he refers to it, the sub-$30,000 automobile, you'll gain a significant portion of the market, make a sizable amount of money, and you can be sure that it will see you through until the introduction of FSD in 2030, and I agree with that point. But in the case of Tesla, it will be extremely difficult to launch this car because it will be cannibalizing a lot of the current inventory, such as the Model 3 right now with the credits. It won't be significantly more expensive than the Model 2, so I'm not sure if Elon Musk wants to do that in particular. Do they really want to? Development obstacles exist. It's a terribly difficult position. Nobody is particularly interested in selling a lot of cars right now. Thus, it's not here yet, but it will be here in 5, 6, or 7 years. It's too soon for me to recommend investments based on something that hasn't been proven to work yet, and the main disagreement between Dan and I is that I don't think the steering wheel is where it's at, which implies that FSD will only become mainstream. I believe the timeline is much faster than 2030 because, as you can imagine, we're talking about self-driving cars that can literally drive themselves 100% of the time. Additionally, Tesla can profit from federal safety deposits, FSDs, even though they still require a highly advanced driver assistance system that operates at a lower level than Atom 5. In my opinion, the finished product doesn't have to be a sci-fi driver list as Dan sees it. And if Tesla has the exclusive license to use this technology, I predict that they will profit greatly from the software, which is Tesla's ultimate goal and something that Ron Barron has been talking about for years. When this standardizes, Tesla will no longer just be an automaker. Instead, it will become the owner of the driverless technology that is used by everyone. I believe this will be a disastrous development for Tesla stock. Warren Buffett actually said, "You have to be greedy when everybody else in the house is scared." That's just the way things are. Being greedy isn't easy when everyone else is telling you how awful Tesla is. That's just poor feeling. That's easier said than done. But as you well know, the astute long-term investors, the bulls, keep buying. That being said, I agree with Dan's statement at the end of the interview, which was, "This is what I need from the upcoming earning call. Give me updates on margin, give me updates on deliveries, and show me how everything is progressing, including AI robotics." Additionally, Dan said, "Give me a little more transparency in the short term and address the issues instead of just saying, 'That's irrelevant, that's too small, we have much bigger fish to fry.'" Dan's assertion that you can tell investors what will happen in the next 2 to 3 years, even if it means sounding like a car company when you make these small updates, is something I think is not mutually exclusive. You can tell investors that you have a cataclysmic volcano eruption of profits and revenue from FSD, from robotics, from all these things, which I believe to be 100% true. I believe he is correct, so why not? Once more, I don't think anyone can truly advise Elon Musk on anything. The man is among the richest people on the planet and a billionaire. He has shown beyond doubt that he is independent of others' opinions, but it seems to me that Dan is stating that in order for us to continue purchasing Tesla, you must demonstrate to us some degree of risk management and de-risking of the situation. In other words, you must play the game by our rules because we are institutional investors. And I have told you that we completely understand that you are unique and that we will grant you some additional leeway. We don't give other firms, but you have to give us something here. Ultimately, though, he still believes in the company's potential for growth. In the United States, Tesla has reduced the cost of a number of its electric vehicle (EV) models by up to $2,000. This represents yet another modification to its pricing approach in the face of worsening market conditions. According to Electrek, the price cut only applies to Tesla's Model Y, Model S, and Model X. The Model 3 and the recently launched Cybertruck continue to have the same prices. Tesla's stock fell on Friday once more, and it has now lost over 40% of its value this year. With this action, Tesla's best-selling Model Y's pricing has dropped to its lowest point ever in an attempt to increase sales following a quarter that saw underwhelming delivery numbers. The company's inventory levels have significantly increased, according to its quarterly report. The price changes coincide with a turbulent period for Elon Musk's business, which recently saw the resignation of 2 senior executives and a 10% reduction in staff. The news that Tesla had postponed plans for a more inexpensive $25,000 sedan particularly disappointed investors. Analysts revised their models accordingly, and Deutsche Bank downgraded Tesla's recommendation to hold. We believe Tesla's move challenges our thesis and raises the possibility of a difficult ownership-based transition for the company. Analysts at Deutsche Bank stated that investors who had previously been fixated on Tesla's EV volume and cost advantage may have given up, eventually to be replaced by AI/tech investors with significantly longer time horizons. As we conclude this discussion on the Tesla stock crash, it's important to take away several key points. Firstly, stock market volatility is a reality that all investors must face. No company, no matter how innovative or successful, is immune to market fluctuations. Tesla's recent crash serves as a reminder of the risks associated with investing in individual stocks. particularly those that have experienced rapid growth. However, it's crucial not to let short-term price movements cloud our long-term investment strategies. Secondly, understanding the factors behind Tesla's stock crash can help us become better investors. In Tesla's case, concerns over production delays, regulatory challenges, and competition from traditional automakers have all contributed to the recent downturn. Additionally, broader market trends, such as rising interest rates or shifts in investor sentiment, can also impact Tesla's stock price. By staying informed about these factors and conducting thorough research before investing, we can make more informed decisions and mitigate risks. Thirdly, market crashes often present buying opportunities for long-term investors. While it may be tempting to panic sell during a downturn, successful investors view market crashes as opportunities to buy quality stocks at discounted prices. Tesla, despite its recent challenges, remains a leader in the electric vehicle industry with strong growth potential. For investors with a long-term horizon, buying Tesla stock during this downturn could prove to be a lucrative opportunity. Finally, it's crucial to maintain a diversified investment portfolio to reduce risk. While Tesla may be an exciting investment opportunity, it's important not to put all our eggs in one basket. Diversification across different asset classes, industries, and geographic regions can help spread risk and protect our investments from sudden downturns in any one sector. In conclusion, while Tesla's recent stock crash may have rattled investors, it's essential to keep a level head and stick to our investment principles. Market volatility is inevitable, but by staying informed, diversifying our portfolios, and maintaining a long-term perspective, we can navigate through turbulent times and achieve our investment goals. And if you found this video helpful, don't forget to give it a thumbs up, share it with your friends, and subscribe to our channel for more investing tutorials and market updates. Thank you for watching, and happy investing!